Hello and welcome to video number 1 for Chapter 5 of Accounting 205. This chapter discusses itemized deductions. Alright, so would you please go to page 5-5 in your book and either put a post-it note or bookmark or take it out. That is the schedule that we are going to be focusing on in this chapter. All right, to itemize or not to itemize, that is the question. All right, a lot of times when people say that they're going to do long form, that means they're referring to Form 1040. And they're also referring to the fact that they can itemize their deductions instead of taking the standard deduction. Okay, so let's go back and let's review again what a standard deduction is. All right, if you go to page 1-19 in your book, all right, you see that the standard deductions are as follows. Single, $6,350. Married filing jointly, $12,700. Married filing separately, $6,350. Head of household, $9,350. And qualifying widow or widower, $12,700. Okay, so in order to itemize, you have to be able to add up your deductions on the lines 4, 9, 15, 19, 20, 27, and 28 of Schedule A, and that amount, that total amount, has to beat the amount on page 119 for your filing status. Okay? All right, so now one important thing here. All right, I've often said to you that married filing separate has several disadvantages. And one of the disadvantages of married filing separate is that if one of your spouses, all right, itemizes, the other one must also itemize. So generally, married filing separate only works for couples that both have a high income and have a lot of deductions. Okay? All right. There might be some other instances where it would be beneficial to file married filing separate, but this is one of the drawbacks. Okay? All right. So just keep that in mind if you get a couple that come in your office and say, well, we want to file separately. Like, okay, that's fine. But, and you can, for example, let's say, they both make the house payments. All right. You could take any mortgage interest that was in both of their names and divide it any way you want to between them. You could do it 50-50, you could do it 75%, 25%, it doesn't matter, as long as you don't exceed the total amount of the deduction between the two returns. Okay, so that's just an added point that that the author probably won't elaborate on too much in this book. All right, so we're going to start in Chapter 5. All right, and we're going to go to page 5-2. And we're going to talk about medical expenses. So we're going to be talking about pages 5.2 to 5.5 right now. All right. The largest medical expense that most people have are the health insurance premiums that are deducted from their paychecks. Okay. All right. In almost every single case, those taxes or those premiums are deducted pre-tax. So don't make the mistake of deducting the health insurance premiums on line 1 of Schedule A if they are already pre-tax. All right. More often than not, you're not going to know what that number is anyways because it doesn't appear on a W-2 form except for the ADP W-2s. The ADP W-2s tend to show the amount that the employee paid, but it still doesn't matter. All right. Those are pre-tax. And you can't have it, you can't double dip here. All right. Okay. So health insurance premiums generally do not qualify as medical expense. Now, on the other hand, if somebody is on Medicare, all right, and they pay Medicare Part B, Part C, or Part D premiums for, additional supplements and or prescription drug coverage, that is fully deductible on Schedule A. all right, because that is paid out of post-tax dollars, not pre-tax dollars. If you're on Social Security, remember, you're not working. You're getting a retirement income from the government. Okay, so what qualifies as a medical expense? Well, the normal ones count. Going to the doctor, going to the dentist, all right, going to the eye doctor, all right, going to the hospital, all right, and again, you will claim on line 1 of Schedule A, you will claim the amounts that you paid out of pocket, all right, and by the way, you had to pay them out of pocket. All right, if you've got like a $5,000 medical bill sitting on your desk and you haven't paid it yet, you can't claim that. All right, you can only claim what you have paid or what you charge to a credit card, for example. That counts. If you put it on your MasterCard or your Visa, all right, to pay a medical bill, that counts. Okay, all right. So what doesn't count? Well, for one thing, non-prescription drugs don't count. So if you go to the store and you buy a bottle of Tylenol, all right, that doesn't count as a medical expense. All right. Okay. On the other hand, if your doctor prescribes you Tylenol with codeine and your pharmacist fills that order for you, that counts. All right. Again, of course, assuming that you're paying with post-tax dollars. All right. All right. Other types of medical insurance, all right, are, for example, nursing home coverage, what they call long-term care insurance on page 5-3. Okay, that is deductible up to certain limits. All right. Very few people have that kind of insurance, so you would have to go to irs.gov to look up the current limitations that you have for long-term care or nursing home coverage. All right. Also on page 5-3, they talk about insurance policies that pay a specific amount. All right. For example, AFLAC. All right. That is where you buy insurance with post-tax dollars. All right, and then you receive, a fixed amount if you get, hurt or injured. And while the premiums for AFLAC are not deductible, the amounts that AFLAC pay you are not included as income either. All right. Okay, so again, that's just something that you have to look at. All right. Capital expenditures at the bottom of page 5-3. All right. For example, the doctor says that your child has severe asthma and needs air conditioning. You might get away with buying a window air conditioner for your son's bedroom. You would not get away with buying central air for the whole house, more than likely, unless it was that severe and it was mandated by the doctor. All right, I've had people who tried to write off a swimming pool because, they had arthritis. No. But on the other hand, like a chair lift, to go up and down stairs, even an elevator, all right, in a house, could be considered a medical deduction. All right, it just depends upon the individual. All right, transportation. All right, transportation. You can deduct 17 cents a mile, all right, back and forth to the doctor. All right, for every trip that you take to the doctor, just make sure that you keep a record of it. All right, and you can deduct up to $50 a night for lodging. For example, you had to drive to the Mayo Clinic or the Cleveland Clinic, or you had to go down to Riley Hospital in Indianapolis and you had to stay there. You can deduct up to $50 per night. Okay, so kind of review page 5-2 to see what qualifies as a medical expense. All right, the last thing about medical expense is look at the first paragraph on 5-2. All right, what you do is you add up all of your out-of-pocket medical expenses that were not covered by insurance and were not pre-tax, okay, and you put that amount on line 1 of Schedule A. Then you look at your AGI and take that amount times 10% and put that amount on line 2. Then you subtract line 2 from line 1 and the difference goes on 3. All right. Okay. Well, I'm sorry, change that. The AGI goes on line 2 and 10% of the AGI goes on line 3 of Schedule A. All right. Then you subtract line 3 from line 1, and if the amount is positive, then you put that amount on line 4, and line 4 becomes your possible medical deduction. Keep in mind that line 29 of Schedule A has to beat the standard deductions on page 1-19. So just because line 4 happens to be, a positive number where you can take medical, remember that it's still part of an aggregate amount. Okay, that's it for this, for the medical part. Oh, except one thing. If you are 65 or older, all right, if you're 65 or older, line 3 of Schedule A changes to a percent of 7.5%. Okay, so 64 and under, it's 10%. 65 and over, line 3 is 7.5%. So in other words, it's a little easier to deduct your medical if you are 65 or over.